Micron delivered the most profitable quarter in its history. Then its shares and a whole cluster of AI hardware names dropped together. The earnings release was clear. The sell-off was visible. The missing piece is the explanation. What changes when a trade can reverse before anyone agrees on why? First, separate the operating scoreboard from the market's mood swing. Micron reported fiscal third quarter revenue of $41.46 billion. The prior quarter was $23.86 billion, and the comparable quarter a year earlier was $930 billion. The shape matters more than the headline. 3 reported points that turn a recovery into a steep staircase. The earnings power was just as striking. Reported gross margin reached 84.6%, compared with 74.4% in the preceding quarter and 37.7% a year earlier. High sales are one thing. This margin progression is why investors read the release as evidence that memory had moved from cyclical nuisance to scarce infrastructure. Micron also recorded $28.24 billion of GAAP net income, or $24.67, a diluted share. That is the receipt behind the supercycle story. Demand is not merely showing up in a lab demo or a shipment forecast. It is already flowing through a reported income statement. The product language supported that reading. Micron said HBM4 was already shipping at high volume for a leading customer platform, while samples had reached several end customers. It also highlighted high-volume products across SSDs, server memory, mobile memory, and automotive NAND. The story Wall Street heard was breadth, not a single lucky product. Then came the forward test. Management guided the next quarter to $50.2 billion of revenue, plus or minus $1 billion, and roughly 86% gross margin. It also pointed to multi-year customer agreements. Guidance is not a result. Yet it explains why the record quarter was treated as a claim about durability, not just a backward-looking spike. Now look away from Micron. The next clue is the basket. On the scanner's July 16 snapshot, the decline did not stop at Micron. Western Digital, SanDisk, Marvell, ARM, Supermicro, and Seagate all fell too. The smallest move in that group was Seagate's 547% decline. Micron and SanDisk were each down about 8.6%. This is one picture, not 7 unrelated stories. These businesses are not identical. Memory makers, storage names, a chip designer, a server builder, and an architecture company occupied different rungs of the hardware chain. That diversity is exactly why the synchronized move is informative. The market was temporarily pricing a shared exposure, the AI hardware demand narrative. Micron's available post-earnings series makes the whiplash visible inside one ticker. It rose 15.7% on the earnings day, remained positive through the next 3 points, then turned negative at the following 2. A price path like that can make an earnings reaction look settled right until it is not. And here is the uncomfortable part. The supplied record names no single confirmed trigger. That absence matters. We can document the earnings release. We can document the shared price declines. We cannot honestly insert a hidden cause between them. No supplied source confirms one sector-wide catalyst for the reversal. So this documentary will not manufacture a villain, a policy shock, or a demand collapse simply to make the chart feel tidier. My read is about market structure, not a secret event. A crowded theme can reward every new confirmation of demand. That rising confidence pulls related names into the same story. Then, a wobble, even without a universally verified headline, can force the same grouping to reverse. The information may be sparse. The positioning can still be dense. Picture the market as a cat carrying 7 identical helium balloons labeled AI hardware. On the way up, the balloons look like proof. When one hand lets go, everyone notices they were tied together. That is a metaphor for correlation, not proof that any company's business suddenly changed overnight. This distinction is the core discipline. A single session price move measures what buyers and sellers did with shares. It does not, by itself, rewrite the revenue already reported, the margin already reported, or the guide management issued. Price can be a referendum on expectations before it becomes a referendum on operations. The honest conclusion is narrower than panic and sharper than a shrug. The unexplained basket move suggests a trade that has become highly sensitive to its own narrative. That is not proof of a broken memory cycle. It is evidence that the market has bundled several companies into one expectation machine, and expectation machines can change direction quickly. The next test is less cinematic than a sell-off. It is far more useful. Start with Micron's own scorecard. The company set a next quarter revenue target of $50.0 billion with a $1 billion range and an approximately 86% gross margin outlook. Those are the numbers that turn the supercycle narrative into a checkable proposition. The next report will either add another receipt or force a rewrite. Then watch the basket, not only the headline name. If future company-specific information produces company-specific moves, the market is doing more sorting. If unrelated hardware names still lurch in lockstep, correlation remains the signal. That does not predict the next direction. It tells you what kind of market you are looking at. Micron's quarter established an extraordinary operating benchmark. The synchronized reversal established a different fact. Market conviction can travel faster than company evidence. So here is the question worth answering in the comments. When the next data point lands, will this group trade on separate receipts or on the same shared story again?